Well, one of the major themes of this earnings season has been big tech and AI. Upbeat results from Mag 7 giants Amazon and Meta, at least, driving markets higher last week. Meta shares rising 20% after beating the street's estimates in the fourth quarter. Shares up 15% over the last week in aggregate here. Now, investors are particularly optimistic around the company's AI goals. Our next guest is bullish on Meta's future as one of three big AI leaders. Here with more, we've got Josh Beck, Raymond James, Managing Director of Equity Research. Great to have you here with us today. So take us into your thesis on Meta after this year of efficiency and after this turnaround that Mark Zuckerberg and team have had to really chart.
Yeah, well, thank you for having me on the show. Last year was really about recovering from some of the privacy headwinds in the industry and instilling efficiency in the company. Obviously, there was a growth at all costs mindset really across tech. And I think Meta really embraced being able to grow and show profits. And, this year, 24, we really think the lens for tech is your AI strategy and your AI monetization path. So it's less about just growth at all costs, less about efficiency, all about AI. And we really think that Meta scores very favorably. They're a little bit of an unsung hero, I would say. When people think of AI, I think they think of Nvidia, they think of Microsoft, rightfully so. Both of those companies have done really well. But I think what's gone unnoticed is really some of the incremental monetization opportunities in advertising. So think about serving content that's more personalized. It's more likely to generate an interaction. That's really helpful to Meta's model. And that's why we actually think they can grow 2x the ad industry in 24.
Wow, Josh, that certainly is a very bullish call. And putting in perspective a lot of what we heard on the earnings call last week from Meta, from Zuckerberg, and also just what that then means for the opportunity going forward. When you're stacking up Meta versus Microsoft versus Nvidia, like you just talked about, not exactly are always top of mind, at least when it comes to AI plays. When it comes to some of those other opportunities out there, where do you stand on the fact that, hey, a lot of this hype has certainly already been built up or built into the valuation of some of these premium names?
This is a top investor question, which is, where are we in the hype cycle? Is there still profits to be had? And our view is decidedly yes. We look at it really in a few different ways, but a lot of the interest and success that you've seen with Nvidia, for example, has really been an infrastructure and data center build. So that's more or less step one to really creating these new AI services. Step two is certainly implementing them in the consumer space, as we've talked about with Meta, and the enterprise space where we see more opportunity for Amazon. And those initiatives are still really early stage, in my view. Meta has seen some nice lifts in engagement, but we really think it's actually very early. And we also think they're doing some very unique innovation around the advertising stack that will eventually boost returns for advertisers. And to us, that's very early stage. The best barometer for this is really looking at them outperforming the broader market. And they really have not, if you look at the last 2 years, but in years 24 and 25, we do think Meta will outperform. So we think that the investor focus will shift from more or less building the infrastructure to monetizing these data centers. And we think certainly Meta on the consumer side and Amazon on the enterprise side are very well positioned here.
Are they able to build this out entirely internally and home grow things, or do you think that we're due for some sort of generative AI blockbuster deal to come?
It's a good question. So I think there will be lots of different applications of these models. I do feel like the largest consumer internet platforms, for example, a Meta, a Google, will have to build this technology themselves. So one of the other messages from the Meta call was they raised the top end of their CapEx guidance. And one of the messages was they want to really be able to build out another very large scale AI service. So they don't really want to stop here. So I really think for the large consumer internet platforms, they're going to have to build a lot of this technology themselves. Obviously, they're sitting on a treasure trove of data, so it makes a lot of sense. Now, once you get into the mid-scale companies in internet or enterprise type of companies, there I think partnership models will make a lot more sense. I don't know that it will necessarily be one blockbuster deal, but I do think you'll start to see, as we go through the year, more proof points that either these enterprise proof of concepts around areas like customer service, which Amazon is working on, for example, or some of these more consumer-facing applications on, for example, creating personalized advertising for every single consumer. I think you'll start to see more of that unfold as we go through the year.
Josh, before we let you go, let's talk about Snap, because we'll be getting results out from them after the bell today. The company cutting about 10% of its workforce. We know it's been struggling with this ad slump. What do you expect to hear? What do you want to hear in order to be a little bit more constructive on this name?
At Snap, there's a lot of, I think, interesting progress being made under the covers, more or less. They've really tried to improve their direct response ad unit. So this would be something like an e-commerce shopping ad unit. And I think they've made good progress. Right? Are they up to the same level as a $100 billion plus company in revenue like Meta? No, but we do think they're making progress, and they're helping bring back advertisers that they lost in the wake of some of the Apple privacy changes. So we look for really how they're doing on direct response, where we do expect an upbeat message, as well as Snapchat Plus. So this is a premium subscription product. It hasn't really worked broadly in social internet, but for Snap, it's worked really well. I think with their demographic, there's a lot of interest to be able to have access to advanced, unique features. And it's becoming a very sizable business in and of itself. And we think that could drive upside in the quarter. So we actually think they're making nice progress on the top line. And when you hear about some of the news that's come out recently, I think the read-through there would be they're also trying to become more efficient. Certainly, that was the message from Meta. This is not the first, reduction in force that Snap has done, but there was certainly a large overhiring that happened the last few years. And I think with this move, they're trying to show investors and really run the business more efficiently. And I think that's good news.
All right, Josh Beck, great to get your insight there. Raymond James, thanks so much for joining us here this morning.